Greetings to Dr. Faisal bin Basri. We are from Group A, Group number 15, and our company name is Perodua. So these are our group mates: No Sabrina Hanim, Preslin Burnham, Desiree Wilon Christian, Nazatul Akila, and Sharmila.
A very good day, ladies and gentlemen. My name is Desiree Wilon Christian, and my matrix number is D2020-1092723. And today I will be talking about the executive summary of Perodua. Perodua, also known as Perusahaan Automobil Sendirian Berhad, is a Malaysian automobile industry that has been established in the year 1992. It specializes in this particular industry, and it also specializes in the production of cars and is known for the production of affordable and fuel efficient vehicles. It has gained a widespread popularity and is one of the leading car manufacturers in the country. It focuses on innovation, quality, and customer satisfaction. It remains a key player in Malaysia's automobile industry till this very date.
Capital structure consists of identifying the relative proportions of debt and equity that a company employs to fund its operations and investments. There are three types of calculation, which are capital structure, total debt to total assets ratio, and long-term debt to capitalization ratio. The formula for capital structure is debt obligations plus shareholders' equity. As we can see, Perodua's capital structure increased consistently from 2020 to 2022. It is because an increase in the equity component of the capital structure signifies that the Perodua is growing its funding through the issuance of additional shares or the retention of earnings. This may suggest that the company is generating capital for its operations from within or by soliciting additional investors. Furthermore, an increase in the debt component indicates that Perodua is becoming more dependent on borrowed funds for the purpose of financing its operations and investments. This could potentially signify the company increasing its issuance of bonds or loans. The debt ratio assesses the amount of leverage employed by an organization by comparing its total debt to its total assets. The formula is total liabilities divided with total assets. There is a decrease from 2020 to 2021, but it is increased in 2022. The reason of decrease is because Perodua is relying less on debt to finance its assets, which may improve its financial solvency and stability. And the reason of it increased signifies that a greater proportion of the assets of Perodua are financed through debt. This may indicate an increased financial risk for the company given its heightened dependence on borrowed funds. The calculation involves the division of total available capital, which includes long-term debt, preferred stock, and common stock by long-term debt. The formula is long-term liabilities divided with open bracket total long-term liabilities plus total shareholders' equity close bracket. The ratio in 2022 decreased in 2021, but it increased in 2022. Reason of decrease is because Perodua retires or repays a portion of its long-term debt and has diminished its dependence on long-term debt as a financing source, potentially resulting in reduced interest expenses and financial risk. And the reason of increase is because the ratio indicates that a greater proportion of the company's capital structure is funded through long-term debt as the numerator increases.
Hello, I am Sharmila. We will be looking at analysis on ratio comparison, which consists of three of them, which are earnings per share EPS, return on equity ROE, and debt to equity. First, we'll look about earnings per share. Earnings per share EPS is derived by calculating a company's net profit by the total number of outstanding common shares. One widely used statistic to assess a company's worth is its earnings per share EPS, which indicates how much a company makes for each share of its stock. Since shareholders would pay more for a company's stock if they feel it producing more money than the price of its shares, a higher EPS is suggestive of greater value. The formula for earnings per share EPS is profit or loss attributable to owners of the company divided by weighted average number of shares outstanding. Here we can see the earnings per share chart from year 2020 to 2022. This explains that Perodua earnings per share ratio shows that the company did better in 2022 than in 2020 and 2021. This is because the ratio in 2022 is somewhat greater than in previous years. The profits per share slightly increased from 40.7 cent to 43.8 cent in 2020 and 2021. Better profitability is shown by a company's higher earnings per share. A higher profit per share EPS indicates that the business did well during the reporting period and that investors are ready to pay more for the company's shares, increasing the shares value to current investors. Next is about return on equity, ROE. Return on equity, ROE, is the ratio of a business's net income to the equity held by its shareholders. Return on equity, ROE, measures a company's profitability and the efficiency of its revenue creation. An organization is more successful at turning equity capital into profits if its ROE is greater. The ROE's formula is net profit divided by equity. From this, we can see the return on equity chart from year 2020 to 2022. This explains that Perodua's group return on equity ratio shows that the group did better in 2022 than in 2020 and 2021. This is because the ratio in 2022 is somewhat greater than in previous years. The percentage stays the same in 2020 and 2021 at 10.2% and 10.4% respectively. A greater proportion suggests that a business is more successful at making money off its current assets. Second is Perodua's company return on equity ratio shows that the company performed better in 2020 than 2020 and 2021. This is because, compared to prior years, the ratio in 2022 is a little higher. In 2020 and 2021, the percentages rose to 3.7 and 5.9 respectively. A higher percentage indicates that a company is more successful at generating revenue for its present assets.
The debt to equity ratio measures a company's debt exposure by comparing its total liabilities to its shareholders' equity. A high debt to equity ratio indicates risk, whereas a low one may indicate that a firm is not using debt to expand. Perodua's debt to equity ratio shows that 2020 outperformed 2021 and 2022. Because 2020's debt to equity ratio is lower than in prior years, and significant debt to equity ratio is 7% to 8%. A high ratio suggests a riskier investment because the corporation may not earn enough revenue to pay off its debt. A lower debt ratio indicates that the company has not borrowed money. The firm's debt to equity ratio shows that Perodua performed better in 2021 than 2020 and 2022. This is because 2021's debt to equity ratio is smaller than others, 0 to 0.5%. Debt to equity ratio is often important. A high ratio indicates that the company may not be able to pay off its debt, making it a risky investment. A low debt to asset ratio means the company has not borrowed money to operate. Comparison of ratio. Earning per share EPS. From 2020 to 2021, the earnings per share increased, a sign of growing profitability. The ratio is greater in 2022 than it is in 2020 and 2021, indicating improved performance. The increased EPS may appeal to investors as a sign of possibly strong business. Next is return on equity ROE. From 2020 to 2021, the company's and the group ROE increased, and in
2022, the positive trend continued. The increases in ROE indicate that the business is getting better at using its equity to make money both collectively and individually. In general, higher ROE is seen as positive as it shows improved financial performance and effective resource management to produce returns for shareholders. Last but not least is debt to equity. In 2020, the company and the group would both display a lower debt to equity ratio, indicating a stronger financial situation. The ratio for both businesses show an increase in reliance on debt in 2021 and 2022 respectively, but the subsequent decrease in 2022 reflects better debt management and reduction. A trend towards a lower debt to equity ratio is usually seen favorably as it suggests a possibility for increased financial stability and a decrease in risk.
A very good day. My name is Prislin Purnam. Now I'm going to delve into the world of dividend decision and their profound impact on a company's financial landscape and their shareholders' value. Well, dividend decisions are pivotal because they can significantly impact both the financial health of a company and the value of a shareholders derived from the investment. Now, let's break down the key elements on how Perodua's dividend decision affects the shareholders' value. First up, we have direct income to shareholders. When Perodua issues a dividend, it's like a direct paycheck for shareholders, and also they receive a portion of the company's profit, and that's tangible income to their pockets. This can particularly appealing to investors who rely on a steady income stream, such as retirees. Next, we have the signal of company's health. If Perodua consistently pays dividend or even increases them over time, it's a strong indicator of the company's financial stability and profitability. This can boost investors' confidence and in turn increase the value of company stock. Moving on to the impact of stock prices, dividend announcement can have a direct influence on the stock price. When Perodua increases its dividend, it often attracts more investors who seek those reliable income sources. Conversely, cutting or eliminating dividends can send a negative signal to the market, potentially affecting the stock's value. Investors' attraction and retentions are crucial aspect. Consistent dividend distribution can attract a particular group of investors who seek reliable income like retirees. This demand for Perodua stock can boost its value. Additionally, frequent dividend can encourage existing shareholders to hold on their investment. Last, we have tax implication. The way dividends are taxed can significantly impact investment behavior. Dividend receives a more favorable tax treatment compared to capital gains. This makes dividends paying stock like those of Perodua's more appealing to investors and potentially increases the company's market value. So in essence, Perodua's dividend decisions have far-reaching consequences, from providing direct income to shareholders to sending signals about a company's health, affecting stock prices, attracting and retaining investors, and even influencing taxation dynamic. Thank you.
In conclusion, in order for Perodua to succeed in the dynamic auto industry, it will have to emphasize on the reliability, affordability, and efficiency. Over the last 3 years, the return on equity shows that there is a higher financial performance and also a resolvable management. The debt to equity ratio increased in 2021, but it has then been recovered in 2022, indicating that there are also better driven investors. Consistent or rising dividends indicate that the company's financial health, which can boost investors' confidence in the stock value. The dividends increase Perodua's stock appeal to income seeking investors and boost demands. With rising EPS, ROE, and debt management, Perodua is performing well. The dividend policy affects shareholders' value by generating income, communicating firm health, influencing stock prices, attracting and retaining investors, and affecting taxes. Thus, Perodua's financial performance and dividend policies may increase shareholder value, but also industry standards and must be considered. Thank you.
So that is all from us. Thank you.